So last month we had Catherine Jacobs in with Warner, Norcross, and Judd doing a segment on retirement and estate planning and things like special needs trusts and all kinds of things that would be needed to plan for retirement. So if you missed that one, please go to our Facebook page, because the live presentation, you can just replay it whenever you'd like to and catch that one. Tonight we have Evan Vanderway with Cornerstone Wealth Partners. He and his brother Steve Vanderway, we rely on a regular basis to relay our clients to him that need that kind of help. And they do the same for us when they need help with health insurance and Medicare and things like that. So we've asked him to come tonight to talk about, in retirement, the investments in your nest egg. It's one of the biggest fears, right? You've worked your whole life to build this up, and we now have to make it sustain us through the rest of our lives. And helping to understand how we're investing and how it's cared for and the decisions that we're going to make is a really important thing. So we've asked Evan to come in to talk about those things with us. So with no further ado, please go ahead, and I'll keep my eye on the door for anybody else that comes in. Okay.
Thanks, Melinda. Appreciate it.
Absolutely.
And as she mentioned this, as I walked in here today, she said, I met with 2 of your clients this week. I live out in Lansing. My brother Steve and I started Cornerstone together 2008, 15 years ago. So think about that. January 1, 2008, we opened a registered investment advisory firm. Isn't that great timing?
Right.
It was actually great timing, because in 2008 there were articles written about just huge numbers of percentages of families and households who were looking for a new advisor or new advice because the market was crashing. We'll talk about that in a little while here as we go through. So I'm glad to be here. I may reference my brother quite a bit. If you're from this area, I'm standing here in his place, and when I stand in the place of my brother, I feel a little bit less of the room. He's this tall, so he says, Evan, you're only 6'5", so that's something he gets to say. But I get to tell him, you only have 10 kids. So my wife and I have 12 children. We love family. We're all about family. I want to start with Cornerstone's why statement and our mission statement. Okay, and then we'll get into the program here. Context is important, and someone gave me this short phrase that I wrote down, and I've thought about often. Welcome, grab some food.
Thank you.
And I'll introduce myself to you again a little bit. And they said context is decisive, and we're going to talk about context tonight. But context is decisive. The reason we make the decisions we make is because of the context we have. And one of the things I'm going to talk about tonight is how to helpfully shift your context so that you can make better investment decisions. But the context of Cornerstone Home Loans is that we exist to strengthen families at Cornerstone Home Loans. That's our why statement. We exist to strengthen families. Families are society's most basic building block. A strong society then comes with strong families, and that's our why statement. Our mission statement is that and this gets a little bit, Scott, to what you were saying, we help families understand the value of their money and then live their purpose in a context of love and abundance. Money does not create love all by itself. It often creates envy, it creates greed, it creates mistrust, especially among family members. Just think about the family cottage after Grandma and Grandpa pass away. Everybody starts to look at it. Maybe it's $1 million. Some people would just rather have the money. Other people want to keep the memories going. It just kind of creates a lot of dissension, right? But if there's a purpose behind all of it, then we can gather around that. And so having a purpose that allows for a context of love and abundance. So that's our context tonight at Cornerstone Wealth Partners, and Steve and I are passionate about it. We have 5 or 6 other advisors. I say 5 or 6 because a new one is coming on here pretty quickly. And a great client service team, so we're excited to help, and we're always glad to work with Prince, so thanks for having us here. Tonight we're going to talk about global economic Armageddon. And the question, maybe rhetorical underneath, is it the right time to panic? That'll be our topic tonight. So let me just go through what we mean by that. And for some of you who came in late, Evan Vanderway is my name. Cornerstone Wealth Partners is the company that I'm with, and we have a very good and close long-term connection with Prince Agency. So we're glad to be here. Our assertions, we start with assertions and then we go through them one at a time. So 3 assertions. The first one is that many investors are experiencing extreme anxiety and fear about the market or about the future as it pertains to their money. Okay? The second assertion is that fear and anxiety can cause us to make bad decisions, can cause us to panic and even sell in our darkest hour. All right? And the third assertion is that the context is critical, and creating a powerful context is critical to weathering the storm. So what I want to show you is the default context that you're in because you're a member of society. And then I want to, at the end, in that third assertion, create a powerful context that can cause you to succeed with money and achieve your purpose. All right, assertion number one. Many investors are living with fear and anxiety of an extreme nature. And this is not an overstatement for me. It may not be something you're feeling or sensing right now, but I do get extreme comments and extreme questions from clients on a regular basis. The types of fear are both economic and political, what's out there, and then it's the personal stressors. So let me talk about what we mean. Anything relating to the economy, Armageddon, dramatic, catastrophic conflict, something that could end things as we know it. Right, I get this a lot from clients. They don't like what they're hearing politically. They don't like what they're hearing in society or in the economy, and they believe that things are going to change materially for them, and they don't like it. And they think that it's related then to what must be happening in the markets. And so when the markets go down, they have serious anxiety and extreme reactions to that. Economic and political. We have war, inflation, recession. How do you get rid of inflation? Create a recession. What are they doing? Raising interest rates, right? They're trying to throw us into a recession to get rid of inflation. Worked for Reagan. Biden's hoping it works here, right? Violence and crime is all over the news. There are still some lingering effects of COVID in our minds and in our way of being, right, around town. Political and social divisiveness. I don't know if you're a student of history. I am a little bit of American history. Most people think that our country is more politically divided today than it ever has been. I don't know if you read the early 1800s and what they were fighting over. I'm not sure that that's true. You know, they only ratified the Constitution by a little bit, right? There were still a lot of people who were not happy about the move that was made. And so there's always been political divisiveness, but we have a sense that's what's happening now. We call this a recency bias. We have a sense that what's happening now is greater than what used to happen. So that's a real fear that a lot of people have, and then you add a market crash to that. Now we have a little bit of a recent one last year. So if this is our context in the news, right, all of these things, and then you add a market crash. Well, let's look at that. Last year, the S&P 500 went down 18%. Right? The Dow Jones, less than that, but it went down almost 7%. The total world markets went down 18%. And even short-term bonds were down almost 4%. Short-term bonds are supposed to be safe. But if you had anything in the intermediate term or long-term bond category, thinking you had a safe investment, the bonds went down, the long-term bonds went down more than the stock market did. So here we have the market context, right, added to everything else. This becomes our default context. This is the water we're swimming in. Something my brother says often in our 2-day event, he says, you know, the fish in the fishbowl doesn't notice the water. It's his context. It doesn't know that it's in water. It's just, that's what it's living in. And this is what you're living in, okay? And then the news does this to you. Now, I just picked The Economist. You can pick anything else that you want to. The Economist is the premier kind of world economic magazine. It comes out of the UK, and it's pretty widely read and followed here by many. But let's just look at each one of these. How high will interest rates go? Well, see, on each one of these covers, they write a question, and then the picture gives their answer. Right? Well, they're going to go up forever, obviously, right? Look at the picture. How high will interest rates go? Well, how high can they go? They're just going to keep going up and up and up. That's interest rates. Next one, when will the ride end? Or when the ride ends, right? Well, what happens when the ride ends? What happens when the upward ride of the stock market ends? Well, obviously that. Yikes. Right? Obviously, when the ride ends, we all plummet to our death because they didn't show us the rest of the fun roller coaster. It's just clouds. It might not even be there. So when the ride ends in the stock market, obviously what happens? Well, everybody dies, obviously, right? That's the picture. The picture gives the answer. And then the Fed that failed, and we have Benjamin Franklin here covering his face. He's the the trusted person, and he's embarrassed of the US Fed, right? Well, shoot. We should be embarrassed. How inflation humbled America's central bank. Negative, emotional, manipulative news in the last 20 years has increased exponentially. Negative news. Look at these areas. Anger, 104% increase in anger posts or anger titles since the year 2000. Fear, 150% increase. Disgust, almost a 30% increase. And titles including sadness, over a 50% increase since the year 2000. Why is this? Well, because it causes us to click or to keep watching through the commercial, right, into the next news feed. They cast a fearful statement. You either have to click on it or watch through the commercial to get it. That's really all they care about, and they know that it sells. So they've devolved into spreading this stuff because they're in competition with one another to sell ad space and to create profits in the news, right? So this becomes part of our context. There's a book called Abundance, The Future is Better Than You Think. Now that seems like a positive statement, but what they're getting at here is, in our minds, we do not think the future is going to be that great. And we've been conditioned to believe it by everything I've shown you so far and a few more things I'm about to show you. The authors, Peter and Stephen, say, taken in total, the result is a population convinced that the end is near. I mean, really, just go and look at the headlines for a while. Just go look at them, and they're really quite disturbing. And they make it as bad as they possibly can make it, and when they can't make it worse in words, they use a picture that answers their hypothetical question to make it appear even worse. And so the whole context, our default context that we're in, if we don't pay attention to the water we're swimming in, is this, right? The end is near. And then you add the personal stressors. I said there was two types of fear, the economic fear and the political fear. We just went through those. You have personal stressors. I don't need to go through 10 slides with that. I'll just give you 10 examples. As I go through these, I'll just let you know, Cornerstone Wealth Partners has about 1,100 client households that we work with regularly. And we come up with a list like this based on the things we're helping them deal with, right? So when you take that economic fears and the political fears, and you add to it what might be happening to you in your personal world, you now have kind of a perfect storm that is maybe set for panic, right? Which leads us to our second assertion. Fear and anxiety can leave investors panicked, which might cause them to sell in the darkest hour. Now, some of these are exciting, but they're still stressful. This would be a darkest hour. This would be, for many people, a darkest hour type situation. We've been talking about, some people retire, and within 6 months, they're in the middle of their darkest hour. They had not prepared for it, right? But then we're sitting here and we're watching the news, right? And some of these headlines come along. And let's get into this. We in the invitation, you aptly said, we utilize Nobel Prize winning research and academic information to create an investment environment, which is both portfolio and coaching, for the investor to succeed, okay? So we're not going to talk tonight so much about the portfolio. We often do. I think William might have. He might have talked a little bit more about the portfolio back in the spring. What I'm going to talk about is the need for the coaching side. And some people say, hey, Evan, I want to stick to the science. Give me the investment science. Well, guys, this is science, okay? What we're going to talk about is real and studied and becoming more and more the attention of investment advisors, or it ought to, because it's a big part of the problem. So Peter Sokol-Hessner, cognitive neurologist, University of Denver, says stress is going to make investors less of who they are, an impoverished version of themselves. Okay? Stress is going to do that to you. And he goes on to say, acute stress puts your body and brain on red alert as your bloodstream floods with adrenaline. Now, I'll admit, I wake up at 4 in the morning sometimes, and I'm freaked out about whatever, right? Did I send that email I should have, or is this client going to be okay? Is my kid going to be okay? This can happen to me, and maybe you've had this sensation Your bloodstream floods with adrenaline and non-adrenaline. Your pulse, blood pressure, breathing rate, sweat production rise. And then here's the bolded statement. Your prefrontal cortex, where you do your long-term planning, it's proven that the activity there goes down, and that's the part of the brain responsible for what you would do in the normal stress-free situation where you would keep on a steady path. Your muscles tense, your body releases cortisol, raises your blood sugar levels, and mobilize your stored energy. So in the middle of a stressful situation, when you need to be able to think, the part of your brain that needs to be active starts to check out. Now this is shown in many different cases. Candice Ryo, NYU neuroscientist, as your threat sensitivity rises, you're more likely to bias your predictions towards something bad. Now why do you think that is? Could it be that all of the inputs that are coming at us every day from just about every angle are bad, right? And then we have a personal stress level event, and we bias our predictions to something bad. So if the market's going down, what's going to happen next? It's going to go down further. If the market's gone up and up and up and up like the roller coaster, what must be coming around the corner? Well, probably a crash. And we tend to think that that's what's going to happen. That's what the studies are showing. Peter Diamandis and Stephen Kotler, these are the two that wrote the book, Abundance. Once we start believing the apocalypse is coming, the amygdala goes on high alert. Now, the amygdala is the part of your brain, it's a little nut-sized, almond-sized shaped thing in the back of your brain. It's the part that manages the things you don't think about, your breathing, your heart beating, right? That one goes into high alert and takes over. So it's sometimes called an amygdala hijack. That frontal lobe where you think starts to have less activity, the amygdala takes over, and it starts to make decisions and it starts to move. That's the one that starts the brain activity, starts to skyrocket when the stressors come in. Filters out almost anything that says otherwise. When you go to the internet thinking the stock market's going to go down, what are you going to find? That the stock market is going to go down. And if you find an article to the contrary, it's going to filter it out, and you're going to just pass over it, and you're going to look for confirmation of what your amygdala just said is true. That's what we're talking about happening. And this is the science behind, the new science behind investor behavior that we're paying very close attention to at Cornerstone through our connection with Matson Money. Jason Zweig, we love him. He's with the Wall Street Journal. He's been a journalist there for years and years. And in 2008, he wrote a great article called Stop Worrying and Learn to Love the Bear Market, right? Stop worrying and learn to love the down stock market. Well, he says stress also, and he said this in 2008, before this science really was taking off, he said stress also impedes your working memory. It narrows the level of choices that you give yourself to consider in making decisions, and it increases activation of the amygdala, a region of the brain that responds to danger. So he was a bit of a prophet back then, 15 years ago. Benjamin Graham, 1949, he wrote the book Intelligent Investor. He was Warren Buffett's mentor, advisor, and friend. He's passed away already, but he said the investor's chief problem and even his worst enemy is likely himself. And he recognized that in 1949 as someone who was involved with investments in a very, very deep way and launched a guy like Warren Buffett, who has also recognized his need for a partner, his need for accountability, and his need for coaching in order to do this well. Because of the amygdala function and media competition, our airwaves are full of prophets of doom. So why do the prophets of doom come? Because we respond to it. Right? That's what we click through for. And they are here for advertising dollars, period. Right? The new X, Twitter, right? He changed his whole scenario, changed the whole brand, changed the whole scenario. He reduced ad cost to attract new advertisers. But it just brought to the forefront again for all of us to see what is normally behind the scenes, and that is that advertising dollars are driving everything. It's driving everything you see on the internet. So all of that's happening. The amygdala kicks into high gear, and then you get Jeremy Grantham, who says today's bubble is worse than 2000. The year 2000, remember the tech bubble had risen, the tech stocks had risen, and then for 3 years the market was was negative. That was the tech bubble bursting. Well, he says, last May, he said 75% tech drop, NASDAQ drop, and a 45% skid in the S&P 500. That was last May 2022. So we're thinking already, because inflation started to heat up in January of 22, Russia invades Ukraine, the market starts to go down, and this article comes out. Well, this is one of the articles that you would have found. And one of the articles you would have accepted and been looking for, really, without knowing what you were looking for. And then the external factors exacerbate the problem. I'm just going to look at social media. And this is an extended video from a Netflix series that you may have seen about social media and Facebook. So I'm just going to play the whole thing, all right? And it just makes the point, and we'll move on from here. But social media is an issue here. It's a big problem in how we get a sense of our self-worth. Scott, you were talking about that. That's a big contributor to whether or not we have a positive self-worth, but what it also contributes to our sense of well-being with respect to the future and our investments. So just listen to this video. I'll just make sure I have the volume in a good place here. So I want to show that for a couple of reasons. One is it's what social media is doing. They know they're doing it. You know they're doing it. You don't feel it when it's being done. But the other part of it is when I show something like that, this very spot makes me anxious. This Netflix thing makes me anxious about it too, right? So I'm learning something from it, but it's also contributing to the level of anxiety I have about the future. It doesn't make me feel like I'm living in a good place or that tomorrow is going to be better than today. It makes me feel like the opposite, right? Maybe it makes you feel like the opposite. And then you have 24/7 news comes behind it. Negative TV news is a significant mood changer, and the moods it tends to produce are sadness and anxiety. Professor of psychology, Sussex University. So this is being studied a lot. And we're coming into this because we know that investor behavior is tied to investor emotion, and tied to actual stressors in your life, and tied to what's happening in the market. And we know what investors do when they feel this way. What we have to do is get under it or behind it, and that's what we're talking about doing. And this mood change exacerbates the viewer's own personal worries, even when those worries are not directly relevant to the news stories being broadcast. So I have had a bad day, there's a bad news story, they have nothing to do with each other, but did it make me feel better? Obviously no, right? But we know that the news is increasingly negative. Multiple overall global unrest and negative news by a market crash, and investors tend to go skittish. So panic, sudden overwhelming fear, with or without cause, producing hysterical or irrational behavior, and it spreads quickly through a group of person, similarly with animals, right? Anything with a relationship. And we know what's happening. This slide is incredible. You know, when the market goes down, we have to sometimes talk about how that happens or why that happens. When the market goes down, it's not just because it wanted to go down today. A market goes down because someone is selling. More people are selling. Everyone wants to sell, right? So when the market plummets, we know people are panicking. We know it. The plummeting market is the proof of it, right? So what we're showing here is in blue, the line is market return, okay, over the year. What I've done here is taken 2000 all the way to 2022. And the market return is in blue. So in the year 2000, you saw that tech crash, then it came back, then you saw 2008, it came back. A little bit of a dip here. This is the 2016. This is COVID right here. And then this is the 2022 dip, okay? That's the market returns in the blue line. In the green shaded areas, or in the green bar graph, it's the net money coming into the market or coming out of the market on the whole. And do you see that this just is illogical and irrational? As the market is rising most of the time, people are investing. And as the market is plummeting, so this little rise in the market created this rise in investing. This plummet in the market created people pulling out. And just about a 1-for-1, every time the market goes up, people want to put money in. And every time the market goes down, people want to pull money out. Now, wouldn't it be smarter when the market goes down, if this was up, wouldn't that mean that the investors were smart? That people would go in, right? But the market's going down because people are investing. So what does the wise investor do? The wise investor has to figure out a way to get away from all of that and either not panic and sell, or even find ways to put more money in when the prices are lower. But what this proves to us very clearly is that investors are panicking, and they're connecting whatever's happening in their life to what's happening to the market, and they're selling when the market goes down. And then they get so panicked sometimes that when the market goes up, they still sell. Go ahead, Jay.
Well, yeah, I was gonna say towards the end there, maybe why is the market up when the flow is down though?
Yeah, it's a good question. People are still pulling money out of the market while the market's up.
Yeah.
There's some jostling in here, and we had just come away from this down period. I don't know if there's a good explanation for it, but what you never see is the alternative, where the market is down and the net inflows are up. You do sometimes see that people still don't put the money in the market even when it's rising. But you never see the converse, right? When the market is going down, are people putting a lot of money in the market? You just never see that.
It kind of looks like it, toward the end of 21, when the market was coming down, the net flows were getting smaller.
Yeah, there's still net outflows, but you're right, they were getting a little smaller there. Sure. But we have a basic pattern that you can discern from the state of the market and the state of the investor, or the activity of the investor. Those are correlated pretty closely. Remember, those who panic and sell usually lose long term. And so we'll go to the new context. So what we showed so far is that investors are relatively racked with fear and anxiety and have personal stressor issues that come in, and that the markets are the connection to markets is there with respect to investor behavior. What we need to do is create a powerful context to weather the storm. And the storm, again, is the storm of the market and whatever personal issue you might be going through at the time. So the context is the interrelated conditions in which something exists or occurs, why we do things. And then there's a concept called terministic screens, talked about by a guy named Kenneth Burke. He says our terministic screen, or the screen through which we see the world, is made up of language and words and other factors. And we see what the screen lets us see. This is kind of the fishbowl analogy. If we're in the water, we don't see the water. We see what the water lets us see. Well, how we see the world, and the case I'm making on the front end, is we see the world through the lens of the media that's handing it to us, right? And through the lens of our personal stressors. But what we need to do is we need to look at the screen and be able to see it. And the current context, or the default context screen, is a context of fear and anxiety, which can lead to panic. It's scary, things look bad, I should get out. That's a default context. Go from there to market timing out of the market will reduce risk for me and my portfolio. So the market's going down, I believe, my context is if I pull my money out of the market, I will have reduced risk. So that's part of my current context, the default context. Things look bad and the market will continue to go down. When I already see the market coming down a little bit and my context is that of fear and anxiety, I believe that it will go down further, and I will find articles to say that, because those are the articles that will sell, when in reality, market prices are random and predictable. So this is the context that I want to build with you. I want to build it over the next just 10 or 15 minutes in order to give you a more powerful context from which to weather storms and make decisions. Market timing, in fact, can increase risk and always increases risk. Just check this out. If we put $10,000 in the market, S&P 500 is what we're using here. You put $10,000 in the market on January 1, 2003, and you go and leave it in there, Rip Van Winkle style, right? You go to sleep. You wake up 20 years later, and it's just been in the market the whole time. That $10,000, if you stayed invested, would be worth almost $65,000. 20 years. Now, if you missed just the 5 best trading days during these 5,000 days that the market was open. 5. Now, no one's gonna do that, I'm illustrating, right? Who could be that unlucky that they woke up on the day before the 5 best days and pulled out and got back in, right? But if you had missed just the 5 best trading days, your money would be at 41 instead of 65. You missed 10 of them, you're at 30. 15 of them, just over 20. You missed 30 days, the 30 best trading days out of 5,000, you're barely making anything. The illustration here is how fast and furious returns come, both positive and negative. But if you pull out of the market, and you're in the market, or you're out of the market long enough to miss a couple of these days, it's devastating to try to get back in. Market timing doesn't work because the best results or the best returns in the market come very fast and furiously.
What if you miss the 5 worst days and 10 worst days?
Again, the point I'm trying to, you would have a huge results. The point I'm trying to make is market timing doesn't work because the days you have to miss and the days you have to make are fast and furious and come on the heels of each other. So your market timing would have to be so precise that it doesn't work. So the context to consider is that crashes happen and recoveries are fast and furious. If this is what your amygdala could know, and when the amygdala kicks in, it tells you this, you'd be fine, or you'd be closer to fine. And maybe you'd call your coach and have a rational conversation rather than going online and look for bad information, right? But this is the context we'd like to create at Cornerstone Wealth Partners. Crashes happen and recoveries are fast and furious. Let me show you. Since 1929, or 1926 really, we have 18 crashes of 20% or greater and 18 subsequent recoveries. I'm just going to read the crashes off to you and the recovery percentages really quickly, okay? Negative 33%, negative 80%, negative 30, negative 21, negative 50, negative 26, negative 23, negative 22, minus 22, minus 29, minus 43, minus 30, minus 36, minus 31, minus 51, minus 27, minus 34, this was the COVID crash, minus 24, this was last year, 2022 through October 1. Okay, so you get a sense for what those numbers were, right? Now let me read the subsequent 18 recoveries and their percentages. 193%, 21, 92, 105, 135, 65, 22, 210%, 936%, 144%, 76%, 844%, 817%, 22, 116, 25, 529, and 120. Did you notice something different between those two sets of numbers?
Recoveries are much larger than crashes.
And not even a little bit, right? They're much, much larger. So what's our new context, right? Downturns are temporary and recoveries are fast and furious, right? That's our new context, and I think we're showing that here. I'm going to show it a few more ways.
I would argue that they're more slow and methodical. It looks like the
Well, I'll get to the
crashes-
fast and furious here in a minute, because I'll show you that here a little bit. If we look at 10% declines, now there were more declines that were in the 10% or greater category. If you look past the 10% decline year, by 1 year, your average return is 13.7. If you look 3 years after a 10% or more decline, your average return is 10.6% per year, so that's a 30% return. And 5 years past a 10 or more percent crash, and you're at 10.2% per year for 5 years in a row. So that's more like a 50 to 60% actual rate of return. So we look at what's happening right after the crash, and we're starting to develop an idea that the crash is followed by something positive. And that's what we have to train the back end of your brain to just know. Historically then, the worst time to pull your money out of the market is during a crash. If you look historically, now think about why we would write this way. Historically, the worst time to panic and sell is during a crash. If you sell at the bottom, you lock in losses. We have to say the word historically because the regulators they're probably watching right now. Right, I have to say historically. I can't make it as a statement of fact. I have to say as a statement of what has happened. Right, what has happened historically, 18, 20% plus crashes over the last 100 years. The return has been there right afterward. And if you had pulled out during the crash, it would have been the worst time to not buy or to sell. Historically, market crashes are followed by dramatic and quick recoveries. So this, Scott, will come to what you were suggesting. Here's a crash, we call it the Nixon crash, January 11, 1973 to December 6, 74. We'll look at the Dow Jones here. We'll look at a few other categories as well. The Dow Jones went down almost 50%. The total days the crash lasted was 694. This is a hard one. Sometimes the COVID crashes that are sometimes as steep, but only lasted 3 months and went back up again, those are a little easier to weather. It's not the depth of the crash always, it's sometimes the duration of it, right, that really works on us. This one lasted almost 2 full years. Not all months during a crash are negative, and returned rebounds can be significant. So check these out in the Dow Jones. The Dow Jones, this was your crash period. This was the period of 24 months almost, where the returns were mostly negative. Not all though, so you had some positive periods in there. But once the negative was over, you had 6 months of 39%. I mean, look at this. This 1 month return in the Dow was a 14% return in 1 month. Now, when you panic somewhere in here and you pull out, what's your new question?
When do I get back in?
Do you think you got back in right after this? Probably not. If you panicked and got out because of this, you probably didn't get back in here. In fact, most people waited a little bit too long. Some people for sure did, because obviously the price is going up. But once this starts to happen, you miss 15% rate of return in 1 month, and your returns over the course of that next 5 or 10 year period are muted. You can never get it back. And then another 9 and another 17 over the ensuing period. All that loss was back again in the ensuing 18 months. That's the Dow Jones, so these will be large US companies. Recovery returns can come from different asset categories though. In previous explanations, we talk about diversification. We're not going to talk about that head on today, but I'm going to show you a little bit of it. This is the US microcap stock decile. So these are the very small companies. You wouldn't even know the names of these companies. I think Next Meats is one of them. They're very small, right? It's this non-meat meat that is all the craze. It's an example of a small company. But it also went through that 24-month downturn. Had some big spikes here. But look at this, 40% rebound in January. I would submit to you that just about everybody who panicked in this period of time and sold didn't take advantage of that 40% return in January on small companies. And over the course of the 24 months following, it was well over 100% return to get more than all the money back and then some in that asset category. And that would be a part of a diversified portfolio with Matson Money. Fama French US small value. So here you have small cap, and here you have small companies with low price, a totally separate asset class. And again, the 24-month decline period, and then 60, and then nearly 40, and then 10. And you've got all your money back again inside of about 18 to 19 months in the small cap value index. The 73-74 crash was followed by 20 years of relatively stable markets. If you take a look at that right before the crash, so this is the crash period. If you put $100,000 into these asset categories, the S&P over that 20-year period, the S&P would have grown $100,000 to $856,000. The small value companies, the reason we weight our portfolios to small value is during that same period of time, $3 million is what $100,000 would have grown to in the small value asset category. So we diversify weighting toward these asset categories. We still own in the S&P 500, but less. But it was a relatively stable period. Now, sure, October 1987, Black Monday did happen, right? That was pretty horrendous. You have the early 90s, there was a little bit of a crash before that next run up. But by and large, the 20 years after that big 73-74 crash were very positive. I have a new client who's back in the market after a couple of years ago. This client's back in the market after 20 years of sitting on the sidelines. He pulled his money out after the tech crash, said he wasn't going to be in the market anymore. He put his money in cash in his 401k and just kept adding cash to it, so he got the tax advantage, but no return. and he finally came to our 2-day event, put his money back in the market after 20 years. He missed the entire rebound and 20 years of return. So you think it can't happen that someone could panic, pull out of the market down here, and miss all this? It happens. It's real. And we're talking about, if someone had $1 million, we're talking about the idea of having $8 to $10 million over a period of time like that. Or not. And that's the kind of stuff that the news media is going to try to help you out with in order to help you make a good decision. Down markets are trying at times. Investors panic at the worst possible moment. We call this the panic line. So what would you have if you panicked versus not? If you didn't panic in the S&P 500 anyway, 100 during this same Nixon period would have grown to that 856. We showed you that on the previous screen. If you panicked here near the bottom and you just got the return of the T-bills, right? You just got a 1 to 3 year T-bill return, you'd have about 250. So we call that the panic line. The post-73, 74 recovery was followed by the tech startup or run-up in 95. So the internet was made the same year I graduated from Calvin College up here in 94. I am not a tech person, so I didn't understand these kinds of things very much. I don't think I knew about the internet until 95 or 96, but then everything is .com, right? And this bubble was created. The NASDAQ rose 5 times during that 5 or 6 year period in value. But then it saw an almost 77% drop, resulting in a loss of billions of dollars for investors. So the crash lasted almost 3 years, from the beginning of 2000 to the end of 2022. The international markets, the European large company market went down 12, the Dow went down 6, but the NASDAQ was hit expressly hard. They were .comming pets, and they had no marketing plan for it at all. They just said pets.com and everybody bought into it, right? The stock goes through the roof and there's nothing there. But that's what happened. And what do we see? $5 trillion in market value gone. These are the headlines. But we see recovery quickly again. So you see that the end of that period, we didn't show you the whole decline period, the end of that period, and then you see the NASDAQ starting to come back in pretty big ways afterwards. So again, the fast and furious response or rebound in the market corresponds with the decline. Here's the US microcap. So these are those small companies again. You have that decline period, and then you have a 70% increase period right afterwards. Small value, the decline period again, plus a huge increase right afterwards. Then we take it all the way through 2019. So from 2000 to 2019, we're showing 20-year periods here again. If you take it from the beginning of the tech crash, so I'm not coming after the tech crash, I'm including the crash in it. Okay, this is the S&P 500, the NASDAQ would have been lower than that. I'm including the crash in the period, and all of the $100,000 results would be with the S&P 500 over 300,000, and just about $750,000 in that small value asset category. And that's in the 20-year period that started with the beginning of the crash in the tech market. And had the investor remained disciplined, these would be the results that you'd get in a blended way. You'd be weighted up here, or ought to be, and these would be your results if you maintain discipline and if your context was there to let you do that.
Does that say long-term government bonds paid 400
Oh, it does.
outperformed the S&P?
Yeah, it did. Yeah. It outperformed the S&P long-term government bonds during that period.
Is that unusual?
It
They
is.
outperformed?
Yeah, long-term, it is unusual. It doesn't happen most of the time.
Okay.
Yeah. We don't own long-term government bonds for 2 reasons. One, it most of the time doesn't outperform stocks. And it is frankly just about as volatile as stocks. If you think what happened last year in government bonds, long-term government bonds, when interest rates rise, the net asset value of bonds plummets because they have now a lower price to be able to sell the lower priced interest rate that they have attached to it. And looking beyond the bear is what you would have gotten from the media during that time. That was crucial to remain disciplined. Again, they're not going to be your friend in trying to help you. And the panic line there, you'd have $110,000 in short-term bonds if you put something safe away at the bottom instead of the 324 that the S&P would have given you during the same time. And then a couple more crashes I'll go through here quickly. The housing crash, was a 2-year, about 18-month crash from October 09 to March of 09, October 9 of 07, to March of 09. About 18 months, they call it the Great Recession. Here, $30 trillion in cost to investors. That was the decline. How can we get out of this mess? The Great American Slowdown, how Wall Street ate the economy, and what happens now. I mean, where do they get this stuff, right? How Wall Street ate the economy. Here we see a significant return recovery just months after the bottom. This is the period, 07 to 09, and then you see a huge return, 39 and 7. That's the S&P 500 index. 73% return in small companies post the decline. And then small value companies, 61 and 12. They would call the decline over here, even though the small value provided some reprieve inside your portfolio because some of these were going up while others were going down. That's one of the benefits of diversification. So there are some positive lights during the negative market, but then the huge returns quickly when the market decided that it was over. The 2-year bear market was followed by nearly 10 years of steadily rising markets. So we don't have 20 years on this one because it's just too recent, but I'll give you the years we have remaining. This goes all the way through the end of 2022, where you put $100,000 in. In this case, the S&P performed the best, but you have U.S. small value, small and large value. Every one of them would have just about tripled money over that 15-year period, starting before the housing crisis, October of 07 being the beginning date. Panic line again, holding on for dear life. That's helpful. Thank you, Time Magazine. The panic line here is almost a little more devastating. You'd have lost $50,000 during a period of time where short-term bonds were paying nothing. So you almost, if you had 50 here, you maybe made $3,000 in your short-term safe investments, while the market would have taken your 100 up back to the 342. So a big difference. Think about someone who retired here and panicked here, and they had $1 million in retirement. It went down to $500,000. They panicked, they came out, they didn't have answers, they didn't know how to respond to this stuff, and they built their retirement, or they had their retirement on $500,000, rather than on a line that would have paid them retirement income the whole time and left them with something significantly more. That's a much different retirement. And I'm not talking about the fact that money makes you happy. That's not the point. We're talking about the fact that this is what markets do, and some people don't have the information, and they make decisions contrary, then, inside of their own default context, but contrary to the powerful context that we're trying to put together here. And then lastly, coronavirus. It's very short, 2 months, February 20 and March 20. The market went down 33% in 2 months. Okay. And again, lots of people were panicking. That's why it was going down. 32% gain, 23% gain. Inside of the first year, the money was all back again. Just about by November of that year, the money was all back again. That V-shaped recovery that our president at the time was touting, right? The crisp U.S. microcap small companies, they went down too for 2 months, and then they had huge returns. They were all back within 6 months, and then climbing to the positive. Fama French U.S. small value here too, big declines, and then huge rebound back again, fast and furious. In a matter of months, it comes back. And if you take a $100,000 investment from the beginning of that period, now this is just a 3-year period, right? 3-year total period from 3 years ago, or 4 years ago, February 2020 through the end of December. So a 3-year period in the market, and the small value would have taken 100,000 up to 151. Large value 144, S&P 124. And what was the panic line? It would have kept $100,000 somewhere in the 90s, rather than being able to see a nice gain on the money since then. The post-COVID recovery lasted over 18 months, but just as investors caught their breath, the persistent downturn plagued 2022. I lied, there's one more, forgot this one. The U.S. large tech stocks, long-term bonds, and cryptos, where investors had gravitated towards, saw dramatic losses and volatility. This was the story of the 2022 year. S&P 500, NASDAQ, long-term U.S. Treasuries, and the Bitcoin index. Check these numbers out. In 1 year, 18% down, the NASDAQ composite 32, long-term bonds 29. So I mean, long-term bonds, they have the volatility of stocks and less return over long periods of time, which is why we don't want to advocate owning those. And then the Bitcoin index, the winner of the negative chart at negative 64% just for the calendar year. It was greater than that when you take the whole decline into play. Over the course of history, many crashes have occurred, but they've been followed by strong recoveries. That's what I want solidly implanted in the back of your mind. Great Depression, World War II, Pearl Harbor, Hiroshima, President assassinated, Watergate, Nixon, resignation, Black Monday, 9/11, credit crisis, pandemic. We could list 20 more. These are just the biggest crashes over the time. And yet, if you had put $100,000 into these market types, the S&P 500 would have grown that over 97 years to $1 billion, and the small value to $41 billion. All you would have had to do is not panic during that entire period of time, and almost nobody can do it. For reasons I think we've probably partly described at least, maybe others that might exist for you that we haven't thought of and put on a slide. This is a neat slide. It's the roller coaster to the long-term average, the average being 10% long-term if you can stay the course, and the negatives listed here. On a different slide, someone made the case or made the point that it looks like the up years are more and higher. Well, you can see it here. These are the calendar year returns from 1926 through January of 22. Since 1926, the S&P 500 index has averaged 10. Those small companies and small value companies have averaged 12 and 14. So we use the S&P for compliance purposes. It makes more sense to show that. They say if we put too many slides in a presentation with just the small value in it, we're misleading you. So we stick with the S&P 500 results, but those small value returns are real and part of our portfolios as well. This is just the S&P. This is an interesting one. If the average is 10, how often does it get 10? Or even better, how often does it do something close to 10? Well, only 6 years out of 96 years has the S&P 500 had a return between 8 and 12. It normally is way higher or way lower. It's volatile, right? That's the stock market, but it settles in at a 10% return over time. It's had ranges of returns from positive 54 to negative 43 over those years. This is a good one. This is a good one for that amygdala. Put this one back there. 71 out of the 97 years have been positive, and 26 out of the 97 years have been negative. And when do the positive ones come again?
Right after the negative.
Right after the negative. So train your brain. If you're in the middle of a negative stock market year and you lost your job, don't let those two things tell you that the market's going to come down further. In fact, every time you're in a negative year, you're closer to what's going to be one of the most positive years. That's the truth. That's the truth of what has happened. And then understanding the range of potential outcomes can help you stick with a plan long term. And that's what we're doing here. So we'll end with a few notes here. Only investors who stay the course will get the benefit of recovery. Think diversification and rebalancing rather than panic and selling. It's critical you keep powerful screens or ways of seeing the world in front of you to empower you to avoid the panic and to remain disciplined. You choose your context, threat or opportunity. Do you panic and sell, or do you buy and rebalance? Right? You see that it's very clear. Jason Zweig again in the Love the Bear. A bear market is a gift from the financial gods, he says. And the longer it lasts, the better off you'll be. Instead of running from the bear, you should embrace him. In the article, it had a picture of a little girl with a flower, and there was a big bear right over her, and she was just trying to give a flower to the bear. Just the picture of the way we should think about bear markets. It just isn't something that should comport with the negative things that are in our minds, or the negative things we're hearing, or the negative things we're going through. The two they don't have anything to do with each other. Look at it as an acronym: things I must endure, things I must experience. Good investing takes time. Mark Mattson always says this, I like this quote: no one knows which direction the next 20% will be. The next 20% could be up or down, we don't know that. But the next 100% has always been up in markets. And as a Matson Money client, if you are one, you know this. If you're not one, we'd love to talk with you. Your portfolio is diversified in over 25,000 different holdings, companies, in 78 countries around the world. And it would take a global extinction type level event to take the whole thing down. I'll add one thing to this. And capital markets around the world are growing fast. We started Cornerstone in 2015, and when we were in 2015, you couldn't invest in nearly this many countries. That just wasn't available. Now, many of these are bonds. I think the stock market, we can be in about 40 countries right now. 15 years ago, you could only be in about 25 to 30 countries. So the countries of the world are moving to capitalism. Right? We might be a little frustrated about how our country is handling capitalism. I am. I don't like extra regulations more than is needed. Some regulation is good. I don't like more regulations than are needed. I don't like more taxes than are needed. And I can sometimes feel that capitalism is eroding in our country and socialism or socialistic tendencies are taking over. Worldwide, that's not true. And even in America, we're far more economically free than most of the countries out there that have relative economic freedom. And capitalism is exploding around the world. More and more countries are entering emerging markets and then coming into developed markets over time, every year. So this time is what you and your coach have been preparing for. If you're in a negative time personally, or if you're seeing markets go down in the future, we're glad that they're up a little bit this year. If you're in it, it feels like it won't end. It will. Stocks are long-term investments. Short-term fluctuations are meaningless to the stock market. I get that they're not meaningless to you, but the stock market does not have a memory or feelings. The article I read this morning, or the headline I read this morning, was the stock market is trying to claw its way back from a negative week. So the stock market has fingernails now and fingers, and it's clawing its right. The stock market, they make this thing look or feel like I look and feel, but it isn't. It has no memory. It doesn't know anything. It just is what we are doing. This too shall pass. What you can do now: work with your coach, remain calm and rebalance, maintain long-term focus, create a powerful context, and this last one, control media consumption. And help your kids control media consumption. It's not good for them either. Creating a powerful context, I'm going to end with just a brief invitation or enrollment. If you don't have a purpose for money, if you don't have a purpose for your time, for your life, get one. Figure out what you're doing here, what you're good at, what you love to do. We were created. We were created to do something, and we're created different. Those are some core assertion beliefs of mine. And you've been given desires and passions and gifts and talents, and figure out what you want to make of those and go after that. And as you go after that, that becomes a powerful context for your life, and it will not allow you to speculate and gamble and panic about superfluous things that are going on in the markets and on advertisements. It'll probably draw you away from things like social media and Facebook because you'll just be too busy to spend your time there. Who was it? I can't remember who said this, but someone said, love your life, not theirs. We look at social media and we're just looking at other people's lives all day long, or we look around us, right? But build the life you feel called to build, and some of this stuff falls into place a little bit easier. So appreciate you all listening and online as well. Thanks. And I'm glad to handle any questions that you have.
I just wanted to share one story that has come through my office in watching all of these crashes and recoveries and so forth. One of the most distinct in my fairly recent memory, after the 2020 COVID lockdown, and we were working remotely from home, and because in the health insurance and Medicare business, we were actually considered essential workers. We were actually able to work with clients in person sooner than most people were allowed to go back to in-person meetings. And one of them, there's a company that was closer to Middleville that closed. They didn't even sell. They just closed their doors. And hundreds of people that were employed there lost their jobs. And most of them, I shouldn't say most of them, I don't know for sure how many people were employed there, but a great number of them were pretty close to retirement and sort of just were forced into, say, deciding to take Social Security at 62 years old instead of waiting till 65 or their full retirement age or things like that. And they, of course, the majority of all of their investments were in a 401k that had been deducted from their paycheck and gone in, right? So it was pre-tax dollars. And this one particular gentleman made it to my office, and he, of course, was in a panic because he'd worked his entire life. He now was going to have to retire early, decided to take Social Security, and all of his nest egg was in this 401k that had just gone down 30%. He panicked, and before he got to my office, he liquidated all of it. And so now we have to have conversations about he's not old enough for Medicare yet, and he's got to get health insurance. Well, your health insurance is determined by your county that you live in and your age, but whether or not you get help paying for it is determined by your income. He just cashed out all of his qualified accounts, which meant that on his tax return for that year, his income was massively inflated. So now he's got to pay taxes on all of that money, as well as the 30+% loss that he'd locked in. And he's got to now buy his own health insurance where he gets no financial help to pay for it at over $1,000 some odd a month because his income is so high in that year. And I said to him, you cashed it all out? Yes. And I said, do you have a financial advisor? Because we refer people to financial advisors because I need a coach. Everybody needs a financial coach when you're panicking, right? Yep, I have one. I said, did you talk to this person? Yeah, I did. Well, what did you say? I just said, sell it, cash it out. And what was their reply? He just did it. So I need a coach that's able to keep me on the path of what I've said matters to me in life, what my goals are.
Don't do it. Don't do it.
Here's why we talked about this before. You remember when we said, right, this is going to happen? And remember when we said what happens immediately after this crash, right? So this poor gentleman, I wished, and that COVID 30% loss, I don't know if you guys, I was paying attention to that slide in particular because the rise after it was
So fast.
immediate and fast and high. Yeah,
55 days.
yeah, very short, right?
Yeah, 30% down, he probably paid marginal tax rate 18%, so we're talking 50% loss, and then 12 grand a year for a year or two on the health insurance. We're talking about a 55% loss of money.
Yes, exactly.
Wow.
So having a financial coach that is willing not just to talk to you about markets and things like that, but what matters to you, what is your purpose for money? We all need money, but it's just a piece to the puzzle for our passion and our talents and our gifts in life and what we want to do. Is it family? Is it starting a new business? Is it, traveling and seeing our grandkids? Is it what stage of life are you at and what's your purpose, right? So those things in mind, and ask questions. So anybody have any good questions?
Yeah.
Evans, go ahead, Bo.
People in your industry today, in this, how it's perceived as uncertain times, are you as busy as you want to be? Not as busy as you want to be?
Would I want more clients? Sure.
Okay.
When
But I mean, are people less likely to use your service in this time?
I see.
Now see
No,
things,
that's a good point.
how things are
People-
seen?
I'll give you a little bit longer story. When I was in the mortgage, I've been in the mortgage business too for a long time, 30 years. And when the 90s brought us the internet, there was all the doom and gloom in the mortgage business. People aren't going to come see a loan officer anymore. They're just going to go online and get a mortgage, right? And in the last 10 or 15 years, the wealth fronts and the betterments and some of these other, what are they called? Robo-advisors are coming in. But the problem is you still have the humanness issue. Now, in the mortgage business, I don't do loans anymore personally, but I have loan officers who do very well. People still want advice. The Gen X, they didn't want advice. The next one, they want advice again. They want to meet with people. There's different ebbs and flows. And I think it has to do with results. I meet a lot of 40, 45, 50-year-old people who've gotten chewed up by their just Wall Street, their E-Trade account, or an advisor that wasn't giving good advice, or their online services. These online services pretty much exist to sell you products. And then you have to live with the results, right? And if you find out from somebody, hey, the market's been getting 8, 9, 10%, what am I getting? Well, first of all, I don't know. I suspect I'm getting 4 or 5. I figure out I'm getting 3 or 4 or 5. I don't worry about being very busy, unfortunately, unless someone is working with an advisor or a coach that deals with this humanness problem. People's results are going to be pretty poor, and I'm going to meet them after that. And I wish I could, I want to meet your kids before they make any problems like this, and I meet more and more 17, 18, 19-year-old kids of my clients, and we take them all. We don't have any minimums for that reason.
Wow.
We take $400 Roth IRA payments left and right. That's part of the reason we have as many households as we do. But the households we have are filled up with their 16, 17, 18-year-old kids because we want them to have 45 years of not making any mistakes. I'd love to meet them that way.
Yeah.
But I often meet 45-year-olds who've made mistakes.
Steve, my daughter attended one of it was more during COVID, a virtual event because we couldn't be in person. And out of all the people that were in the event, it was probably 30 some odd people, I would say. She was absolutely the youngest person in the virtual event at the time. And they were taking questions about certain things and value and how many, do you have minimums for things or whatever. And his comment was to my daughter, you have the most valuable asset of everybody that's in here, time.
Yeah.
Because she was 22, I think, at the time.
What percentage of 17-year-olds today are starting to invest?
Maybe 1. I don't see the. I don't know the number.
But
What do they say? 70% of stats are made up right on the spot.
Right.
Just like that one and the one I just said. Not very many.
Yeah.
The ones that do are, they're incredible.
Yeah.
We just did the math for a kid. You put $10,000 away at age 19. The most likely result, if he makes no mistakes, over 50 years, is that he'll have $800,000 on just $10,000. That's if he never put another dollar in.
Wow.
Time is a huge asset.
Yeah.
But even if you're 50 or 55, you've got 20, 30, maybe 35 or 40 years still to be disciplined. And those returns can produce a lot of good retirement income on your nest egg. And so we don't look at someone who's 50 or 55 as being almost out of time. We look at that person as needing maybe 30 or 40 years of good advice and good coaching. So it's never over until it's over.
Got a few, 3 of them to be honest. The price, what's the price of like a coach, and the price of an investor, and like price of having a financial advisor? Are you all in one group?
When I analyze other people's statements or portfolios, I will see what they're paying. Right?
Gotcha.
And we tell them what they're paying. You're paying something inside your mutual funds. You're paying something maybe for custodial fees. These mutual funds have turnover in them. They buy and sell. You're paying the bid-ask spread cost of stock buying and selling, so you're paying that. And then you're paying advisory fees. Right? Yeah. I think the average, I didn't look at it last year, I think the average advisory fee around the country was still just over 1%. The one I saw the other day was 1.4%. We're under 1% for our, just under 1% for our average client, and it goes down with your assets going up. But the advisory services, we call ourselves coaches. We don't charge more for that. We do financial advising, or we bring in someone's tax accountant to help with financial advising. Financial advising isn't that difficult, frankly. It's pretty simple, and there's some rules to obey and some things to employ, like Roth conversions. And when do you take Social Security? And we bring Melinda in for that. And we just put the team together and make that part happen. It's the biggest problem is people can make pretty poor financial decisions, but the biggest problem is getting the return by not panicking. If we can just start by getting 10%, let's just do that. Then we have something to plan with. So that's our focus. We want to help clients be good investors, and then help them make good decisions as well. I don't know if that answers it directly.
Does it cost to come to your company and and get to it.
So no transaction costs, no hourly rates to have me coach you. We have an asset-based price, so when we charge, if you have $1 million with us, we charge a percentage of that. So 0.99%, or if you're over $1 million, it starts to go down from there. So we charge that advisory fee as is normal. Yeah. But we don't charge an hourly rate, or you don't pay a transaction cost.
You touched on something there a minute ago that I've been all hung up on for a little while now, and that's Roth conversions. I'm one of these guys that's worked 2 jobs forever, it seems like, and both places had 401ks before Roths were available.
Yep.
I have still since and still do contribute to Roth in both 401ks that are available now that weren't then, and then the yearly option for the regular.
Yep.
But I find the center bucket too full, and 5-6 years to convert with trouble finding what I really feel comfortable with paying tax on the amount that I have to transfer.
Yeah.
And I don't know if I have to transfer all of it, but that analyzation and optimization, you know, with fees, performance taxes, the conversions included, seems to be a little overwhelming with my limited time frame to work
It
with.
is, and then you take into the fact that usually people are doing this around the time they're thinking about retiring, and then they're
Elevates
thinking
income.
about, you know,
Yeah.
whether they're still under the age of 65 and we've got to deal with their income that will affect their health insurance premiums, and or are they 65 and older and there's IRMA tax, income related monthly adjusted amount, which raises the normal amount that you would pay for your Part B of Medicare. And so I usually say we try to triangulate between the financial advisor, the tax accountant, and us who are doing the health insurance and the Medicare part of it, because they don't usually have our piece to the puzzle and nor the others, right?
And that's the struggle I've had in trying to
It
find.
takes some
someone
serious
that can really
coordination
do that.
between trusted advisors that have your best interest at heart.
I'd love for you to
Yeah.
look at our program. It's called Right Capital. So if you looked at the back end of that, and you could tell us if that IRMA is getting added in. I think it is.
Okay.
So when we do a Roth conversion, essentially what a Roth conversion is that you have money in a traditional IRA where the money went in pre-tax, and it's grown, and now everything that comes out of that is going to be taxable as you spend it in your retirement years, right? That's the traditional form of an IRA or a 401k.
Or
Well-
as they force you to take it out with required minimum
And-
distribution.
At age 73 now, used to be earlier than that, but at age 73 now, they force you to take some percentage of that out. And as you get older, the percentage rises with your lesser life expectancy. So when you're in your 80s, they're asking you to take 20% of the amount out almost. And that drives your tax rate up later. So what we want to do is we want to maybe force the tax issue before you have to do it by converting money from an IRA to a Roth. That way it can grow tax-free in the Roth. So we do elevate your tax rate for a while, but maybe even get to keep it under that 22% rate.
It's hard to do that.
It's hard to do it, but there's an optimization based on your desired spending. There's another thing called qualified charitable distributions that qualify for the RMD. So there's 2 or 3 or 4 strategies. This is where I say financial planning isn't that hard. You just need a good program for it, and you need to apply yourself to it. But you can do it, and you can figure out how much is worth it for you.
Is that something we regularly work with? If I could get a contact number?
Check with Melinda. She'll connect you with my brother Steve here in this area,
Okay,
and his assistant will help you load that up and then run some numbers.
thank you.
And if you want my opinion on it too, Steve and I work together on clients all the time.
Yeah,
absolutely.
it's been a struggle.
Fill
for
out
some
one
of
of
us.
these,
All
right? And there's a notes section at the bottom. Just express, love to chat about
Mhm.
basic planning of Roth
Okay.
conversions, things like that. And then we can make those connections for you. So
Unfortunately, I have a hard stop in a couple
he
of minutes,
does.
but I
Gotta
want to
get to
take
the
another.
family event. So
Yeah.
thank you so much, Evan. Really,
My pleasure.
honestly, everybody was amazing. And I feel a little bit more calm about what you see on the news
Amen.
and hear in social media every day, right?
Amen.
So thank you all for coming. And if you found this valuable and you probably think of, you know what? My sister, my neighbor,
Amen.
my child, my somebody should really have been here to hear this. Please send them to our Prince Agency LLC Facebook page, and you can easily even fast forward to different sections to watch something quickly to bring it to somebody's attention. And help somebody else benefit by it as well.
Amen.
Okay. If you've got any questions about, of course, health insurance and Medicare options, Katie joined us later. She was doing school events, so Katie is one of our other agents, and Joanna and myself, Melinda. Our cards are up here, so take those if you need or find somebody else that needs help, and thanks for joining us.
Amen.
Thanks for coming.
Take more food with you on the way out.
I don't often get amens when I speak, but I take it.
All right, exactly. For sure.
I can vouch for Joanna.
Perfect,
I'm good.
perfect. Awesome.
All right, everybody, watch for deer.
Yes. Yes.
Oh,
See you all.
Take care.
It's been a pleasure being with you. Thanks, Melinda.
Thanks, Evan, take care. I spend about half my time here these days.
Oh, yeah.
Been at the school events.
So
many children.
Thanks for coming,
So-
I appreciate it.
Do you guys have any questions? Everything going all right?
I'm just always striving to